The current account of the EU 27 showed a surplus of €385.5 billion in 2019, corresponding to 2.8% of gross domestic product, GDP. By comparison, in 2018, the current account surplus for Europe was €406.2 billion. The latest developments for the EU 27's current account balance follows the trajectory of the last 3 years, while the current account deficit peaked in 2008 at 1.4% of GDP. It turned into a surplus 1 year later and grew steadily until it reached its absolute and relative maximum value in 2016 of 3.3% of GDP, 417.2 billion euros. Since then, it has been slowly decreasing, amounting to 2.8% of GDP in 2019. The current account surplus of the EU 27 for 2019 was based on a firm surplus in the component account for goods, 2.1% of GDP, while services account, 0.7% of GDP, and primary income account, 0.3% of GDP, further contributed to the positive balance. Secondary income account, minus 0.4% of GDP, recorded a deficit. The capital account also recorded a slight negative balance, minus 0.3% of GDP. Among the partner countries and regions, the EU's 27's current account deficit was largest with China, standing at €87.4 billion in 2019, followed by offshore financial centres, €52.1 billion, and Russia, €24.1 billion. On the other hand, the highest current account surpluses were recorded with the United States, $155.4 billion, Switzerland, $76.5 billion, and the United Kingdom, $71.4 billion. Surpluses were also recorded with Canada, Brazil, and Hong Kong, and to a minor extent with India and Japan. There were 12 EU member states that reported current account deficits in 2019 and 15 that recorded surpluses. The largest relative deficits measured as a share of GDP were observed in Ireland, 9.4%, Cyprus 6.7%, and Romania 4.6%, while the Netherlands and Malta reported the largest surpluses relative to GDP in their current accounts, 10.2% and 9.7% respectively, followed by Denmark 7.7% and Germany 7.1%. In absolute terms, Germany recorded by far the largest current account surplus, €245.5 billion, and Ireland the largest current account deficit, €32.8 billion. By taking a closer look at the current account components, it becomes apparent that the EU 27's current account surplus with the rest of the world is firmly built upon positive balances in the goods and services accounts, €295.3 billion and €103.1 billion respectively. Similarly, the current account surplus for the euro area, €320.5 billion, was mostly due to a surplus in trading goods, €322.3 billion, with the surplus in primary account being slightly higher than for services, €80.9 billion and €68.1 billion respectively. In absolute terms, Germany, €221.3 billion, the Netherlands, €69.2 billion, and Italy, €57.1 billion, were the most prominent net exporters in goods to other countries, intra-EU and extra-EU, while more than half of the EU member states, 16 countries, faced negative balances in their goods accounts in 2019. Among those, France was the major net importer of goods, €46.4 billion, followed by Spain, €28.1 billion, and Greece, €22.8 billion. However, with the exception of the Netherlands, surplus in services of 17.9 billion, the same major net exporting economies in goods appear respectively as net importers in services in 2019 and vice versa, while Germany, minus 20.5 billion, and Italy, minus 2 billion, observed negative balances in their services accounts. Spain was the major net exporter of services, 63.3 billion, to the rest of the world, followed by Poland, Luxembourg, France and Greece, all of them with surpluses in trade in services higher than 20 billion and negative balances in trade in goods. The United Kingdom showed a significant current account deficit, mainly due to a deficit in trade in goods, partly compensated by a surplus in trade in services. Among EFTA countries, Norway and Switzerland reported significant current account surpluses in 2019, 77 billion in Switzerland, 14.3 billion in Norway. These were supported by surpluses for goods in both countries, Switzerland 59 billion, Norway 12.5 billion. A firm surplus for services in Switzerland 15.7 billion, and a firm influx of net primary income flows, Norway 15 billion and Switzerland 12.5 billion. Altogether, 10 member states recorded surpluses for goods in 2019. Data for Ireland is confidential, while 23 member states recorded surpluses for services with the rest of the world. Among those with the largest relative exposure to surpluses in goods were the Netherlands, 8.5% of GDP, Germany, 6.4% of GDP, and Denmark, 5.7% of GDP. Highest relative exposure to surpluses in services were measured for Luxembourg, 37.3% of GDP, Malta, 32.4%, Cyprus, 21.3%, and Croatia, 18.6%. The net importing economies with largest relative exposure in goods were Cyprus, 21.5% of GDP, Croatia, 19.1% of GDP, Greece, 12.2% of GDP, and Malta, 12% of GDP. And in services, Ireland, 21% of GDP, mostly due to transactions in charges for the use of intellectual property and other business services. Around 3/5 of the EU member states' international trades in goods and half of their trades in services was related to trade with other EU partners in 2019. Data for Spain, Malta, Switzerland and Norway is not available. Cross-border trade in goods with EU partners was highest in Luxembourg, 80.6%, and a further 10 countries recorded shares over 70%. The lowest share was reported by Greece, 49%. The corresponding share for Ireland was treated as confidential. Cross-border trade in services with the EU partners was most prominent in Slovenia, Slovakia, Austria and Romania, all above 70%, and lowest in Ireland, 24%. For the UK, trade with the EU 27 partners accounted for 49.8% of its trade in goods and 43% of its trade in services. The current account. The current account of the balance of payments provides information not only on international trade in goods, traditionally the largest category, but also on international transactions in services, primary and secondary income. For all these transactions, the balance of payments registers the value of credits, exports, and debits, imports. A positive balance, a current account surplus, which applied to the EU 27 since 2009, shows that an economy is earning more from its international export transactions than spending abroad from import transactions with other economies, and it is therefore a net creditor, net exporter towards the rest of the world. The current account gauges a country's economic situation in the world. covering all transactions that occur between resident and non-resident entities. More specifically, the four main components of the current account are defined according to the BPM6 as follows. International trade in goods covers general merchandise, net exports of goods under merchanting and non-monetary gold. Exports and imports of goods are recorded on a so-called free on board FOB valuation. In other words, at market value at the customs frontiers of exporting economies, thus including charges for insurance and transport services up to the frontier of the exporting economy. As a consequence, for imports, an FOB free on board adjustment is required in order to deduct the value of freight and insurance premiums incurred for the transport up to the border of the importing economy. International trade in services consists of the following items: manufacturing services performed on physical inputs owned by others, goods for processing, maintenance and repair services, transport services performed by EU residents for non-EU residents or vice versa, involving the carriage of passengers, the movement of goods and auxiliary services, such as cargo handling charges, packing and repackaging, towing not included in freight services, pilotage and navigational aid for carriers, air traffic control, salvage operations, agents' fees, and so on. Travel, which includes primarily the goods and services EU travellers acquire from non-EU residents, or vice versa, and other services, which include construction services, insurance and pension services, financial services, charges for the use of intellectual property not included elsewhere, telecommunications, computer and information services, other business services, which comprise research and development services, professional and management consulting services, technical and other trade-related services, personal, cultural and recreational services, and government services not included elsewhere. Primary income covers basically three types of transactions: compensation of employees paid to non-resident workers or received from non-resident employers, investment income from direct portfolio, other investment and reserve assets, and other primary income, taxes on production and on imports, subsidies and rent. All investment income components cover income on equity and investment fund shares, divided between distributed and accrued income, and interest from investments in debt securities, deposits or loans, and investment withdrawals from income of quasi-corporations. Secondary income includes government current transfers, for example, payments of current taxes on income and wealth, social contributions and benefits, transfers related to international cooperation, and current transfers related to financial and non-financial corporations, households, or non-profit organizations. The capital account of the balance of payments provides information on the acquisition of non-financial assets by residents in the rest of the world, or by non-residents in the compiling economy, for example, investment in real estate. It also includes capital transfers by general government and financial, non-financial corporations, households, or non-profit organizations, also specifically covering debt forgiveness. The financial account. The financial account of the balance of payments covers all transactions associated with changes of ownership in financial assets and liabilities of an economy with the rest of the world. The financial account is broken down, according to BPM 6, into 5 main components: direct investment, portfolio investment, financial derivatives, other investments, and reserve assets. All components are now